Thanks for clicking! Canada should introduce 50-year mortgages to help out with housing affordability. This according to Canadian mortgage brokers and realtors in the wake of the U.S. proposal to extend their mortgages to 50 years.
All it means is you pay less per month, you pay it over a longer period of time.
That's just a straight shooter with upper management written all over him.
Yeah, and in contrast to what we usually see on Canadian Bloomberg, shilling for the real estate industry, U.S. Bloomberg was actually far more skeptical.
Why not just rent your house forever?
Prices don't come down. If you just keep inflating them, the affordability just gets worse.
You guys are gonna get it.
But it's not just that. The never paying off your mortgage, that's the problem. As we'll see today, in contrast to the United States, a 50-year mortgage in Canada would actually be far more risky. So what I want to do today is go over the 50-year mortgage as proposed by President Donald Trump, discuss what that would entail, and then take a look at how the Canadian implementation would actually be far, far worse. Speaking of even worse, the Canadian Real Estate Association, the CRA, is set to release Canada's national real estate data for the month of October in a week's time, and we'll obviously have an update out on that data on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into these 50-year mortgages. On to the 50-year mortgage. President Trump first floated the idea of the 50 years on Saturday, with the director of the Housing Finance Agency calling the idea a game changer. The idea, as alluded to in many of the social media posts we've been seeing advocating for it in Canada, would be to make housing more affordable by lowering monthly mortgage payments. And indeed, those payments would go lower. A $400,000 mortgage with a 4% interest rate on a 30-year amortization has a payment of $1,900, whereas the payment on a 50-year amortization would be $1,542. Or, as the real estate industry's apparent idol puts it,
you pay something less.
And yes, obviously you do save some money on your monthly payment, but that savings is dwarfed by interest cost over the life of the mortgage. On that same 30-year mortgage, you're going to pay $287,000 worth of interest, whereas on a 50-year, that interest payment will be $525K. So that's how it would play out in the United States, lower monthly payments, but long-term you pay much, much more in interest. But the Canadian implementation would be much, much different. Remember, when the president is talking about a 50-year mortgage, he's talking about a 50-year fixed rate mortgage. The US, unlike Canada, has a very rich, very deep securitization market, making it easier for lenders to sell off those 50-year mortgages. So, in the United States, the homeowner takes out a mortgage on their home. That mortgage is held by the bank, which then goes to a broker, which packages them up into a single bond, sells those mortgages off to investors, which may package them up into a bunch of those bonds and sell them off again. And we really don't have that here in Canada. A lot of our mortgages, not all of them, but a lot of them, stay on the books of the banks. And as such, most of our mortgages are limited to 5-year terms. I've gone over in more detail why Canada doesn't have 30-year fixed-rate mortgages in other videos, and I'll leave a link to that in the description. But because of this, because Canadians have to renew every 5 years, that carries with it a certain number of risks. Let's go back to our 30-year and 50-year examples. On that same $400,000 mortgage with a 4% interest rate, at the end of 5 years, that borrower owes $362,000 versus the $386,000 that would be owed on the 50-year. Meaning, if something happens in the housing market between the time that the home is purchased and the time that the renewal date comes around, that could cause a real problem for the home owner. Say, for instance, if everyone piles into the housing market fearing that they'll be priced out forever due to some new government scheme, only to find out later that the popular kids from high school had duped them into thinking basic economics had changed and that house prices can't go up forever without consequence.
That's impossible!
Well, were that to happen, if prices did fall during those 5 years, that homeowner could very well be stuck in a home that is underwater. A home that is not worth what is owed on it. They wouldn't be able to switch mortgage lenders, and as such, they'd have to take whatever rate was offered them at renewal by the bank they're with at the time, which, as many are finding out right now when they go to renew their mortgage, if the bank knows that you're stuck, if the bank knows they have leverage, you're not getting that prime interest rate. Add to that risk, those 50-year mortgages would probably have to be insured. They would have to be mortgage default insured, like through CMHC, etc. Meaning insured mortgage guaranteed by the taxpayer on, as we saw, a far more riskier product.
You have to help me!
So a 50-year mortgage in Canada, as we saw, would be far more risky than it would be in the United States. And as we're also seeing right now, those 50-year mortgages aren't being overly well received in the US either.
I'm not sure this is the remedy.
You don't solve a price problem with a demand-side solution. I just don't.
But who exactly would these 50-year mortgages benefit? Let's say, for instance, they did help would-be buyers, marginal buyers, buy a home. How long would that last? According to basic logic and a paper from our central bank, looser mortgage rules contribute to house price growth, a point which the same industry that is now pushing for those 50-year mortgages made last year when they argued that the extension of a 25-year to a 30-year amortization would result in house price growth. Now, obviously they didn't, and we've had any number of intervening variables between then and now, variables that should have been known at the time. But there's also a big difference in bumping from 25 years to 30 than bumping from 30 years up to 50. So yes, while those first movers, those first ones to use the 50-year amortization may benefit from an increase in affordability on those lower monthly mortgage payments, as house prices got bid up, that would no doubt erase any of those affordability gains.
But this is what happened with the auto loans, right? We saw 10-year auto loans. Auto prices went up, so people had to take out more loans. This is the same kind of thing with a 50-year mortgage.
In the same manner that affordability got better back in 2020 on those lower interest rates, initially everything was more affordable, and then that affordability disappeared as house prices got bid up. So these 50-year mortgages may help out initial home buyers, but not so much future ones. The 50-year would go from being an option to a necessity. And then guess what the real estate industry's new bright idea would be?
Whatever you tell me.
Those 50 years would also certainly benefit me and realtors. We get paid on day one of that 18,250-day mortgage. So realtors, mortgage brokers, banks, those first movers would all benefit from a 50-year amortization. Anyone else, especially those later home buyers, not so much. And look, this isn't how it's getting sold in social media. It's being sold as an increase in affordability, which, as we saw, it is initially, maybe, but it won't be for long if it enables the bidding up of house prices. I saw one social media post tell Canadians that they could take the difference in payment between the 30-year and the 50-year, use that difference in payment, and throw it into the stock market, buying up X, Y, and Z. Don't take investment advice from a people that were absolutely bumfuzzled that the government would lie in a time of crisis, or that money printing creates inflation. Regardless, if we do see this 50-year mortgage come to fruition in the United States, expect to see more and more calls for it coming from the real estate industry here in Canada. But, and this is the part that won't be mentioned, the Canadian implementation would be much, much more riskier than that of the United States. We don't have that rich securitization market. We have mostly 5-year mortgage terms, which carries with them all of those renewal risks that we talked about earlier. Further, and this is just a side note, now that these 50 years have entered into the zeitgeist, it wouldn't surprise me to see politicians start to latch onto it as well, as a means of increasing housing affordability, which, as we saw today, it really won't long term. Probably wouldn't even do it medium term, just very, very short term. With that said, whether or not the US will get those 50 years and it'll come to Canada remains to be seen, but we will obviously continue to track that issue on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, thanks so much for watching.